What's going on, guys? Today we've got a great episode with Darius Dale. Darius is the founder of 42 Macro, and he is one of the smartest people I know on Wall Street. His quantitative measurements of what's going on always inform me, and this conversation is no different. We talk about why the economy is actually more resilient than you may have thought. We talk about whether the stock market is going to hit an all-time high in 2025. He explains why he's bullish on gold and Bitcoin. And then we even talk about what the heck is going on with DOGE, government spending, and tax cuts. I hope you enjoyed my latest conversation with Darius Dale. All right, Darius, you and I were just talking. I said, turn the camera on. We got to record this. All right. Stock all-time high before the end of 2025. I think yes. You seem maybe cautiously optimistic, like it's not a done deal. But you go first. Why do you think that the odds are not likely we get a stock all-time high before the end of the year?
Well, I don't know if I'd say we're not likely. So let me be very clear about this. I think ever since April 9th, the bond market broke President Trump on April 9th. And instead of pivoting us to paradigm B, which would have been multiple quarters of economic hardship in order to right size the economy from being overly allocated towards Wall Street and corporate profits back towards Main Street, I think the bond market broke the resolve in terms of trying to push us through to this outcome. And so ultimately, where I think the probabilities, at least in the marketplace, have skewed to in recent weeks is a move towards paradigm C. And unfortunately for Main Street, paradigm C is essentially paradigm A, which is this sort of, really egregiously top heavy economy that really set up to benefit folks on Wall Street. That on steroids with, trillions of dollars of tax cuts and supply side sweeteners that ultimately will catalyze new all-time highs. So if we're heading to paradigm C instead of paradigm B, not only are we going to get all-time highs, we're going to get a raging bull market.
So paradigm A is where we were. That's how the world used to work. Exactly. Paradigm B was this whole idea of Main Street, not Wall Street. Paradigm C, which I agree is where we're headed. Actually, in my mind, I look at that as we will still have a more aggressive economic policy around tariffs or, quote unquote, the America First strategy. It's just not going to be the most aggressive version, which is where they started at. Right. Correct. And so the tariffs maybe are 5 to 10%. They're not 30 to 145%. All these different kind of economic policies. And so like in a weird world, they're going to have taken steps towards their agenda, but also we're going to get the all-time high. And now I'm only willing to say we're going to get an all-time high by the end of 2025. But I do think that if we get 2 rate cuts, 3 trade deals, 2021, baby.
Like 3 trade deals.
I'm just saying, 2 rate cuts, 3 trade deals. Your boys better be long.
Look, man. I don't disagree with you. The one thing I would disagree with is if trade policy ultimately turns out to be worse than what markets are currently expecting, that, in my opinion, would be a signal that they are comfortable accepting the amount of pain required to get us to paradigm B. And ultimately, I don't know that markets are going to do particularly well in that scenario, given that markets are essentially pricing in essentially a 1-quarter slowdown that's concentrated to the second quarter of this year. When you look ahead in the second half of this year and even into the first part of 2026, you have a significant acceleration in sales and earnings growth expected still. You have a meaningful pickup in GDP starting in the first half of next year. So in my opinion, I think if they send any signal that they're okay with the amount of pain required to get us to paradigm B, I think that will cause markets to reverse, and ultimately we're probably going to maybe even retest the lows. But again, I don't think that's the modal outcome anymore, because in our opinion, our North Star from a research perspective, and it has been this way since April 9th, is that the bond market broke President Trump.
Now, you've got a chart here. The U.S. economy is far more resilient than headline real GDP growth of negative 0.3%. Explain what's happening.
Yeah, so even before we unpack this chart, the whole collection of charts today that we'll walk through is trying to help investors understand where are we coming from and how the bridge from paradigm A to paradigm C is a lot more linear and a lot less fraught with market volatility. You can go from paradigm A to paradigm C pretty easily and have it, sustain a bull run throughout this process. Paradigm B was the real jump condition to a different paradigm, in my opinion, and ultimately that risk is lower. So getting back into this chart, the U.S. economy has been rocking and rolling, and obviously a lot of it is based on Biden's kind of overly fiscally stimulated economy. But until they turn that off, it's going to continue. And so that's what we show here in the bottom panel in this chart. We show real GDP X government and X exports. So if you take out government and net exports and then sort of recalculate the growth rates on that residual time series, we actually saw growth accelerate to 6.2% in Q1. That's the highest we've seen since the fourth quarter of 2021. And obviously, significantly above trend relative to the pre-COVID trends. So this is an economy that is even in Q1 was rocking and rolling from the perspective of kind of the core fundamental, the core underlying strength of the business cycle. Now,
the private sector seems to still be doing very well. The public sector actually saw cuts, and then there was this pull forward from all the tariff worries. Talk a little bit about what you're seeing in the private market here with the second chart.
Yeah, absolutely. So so this is 9 consecutive quarters of real final sales, 3% or more real final sales growth at a modest acceleration in Q1. That's pretty noteworthy, right? I mean, this is an economy where I think if you just walked up and asked the average person, are we a 2% economy or 3% economy? I think the average investor would probably say closer to 2.5%. But this is 9 consecutive quarters of 3% or more type growth. So it's indicative of private real final sales growth. So this is indicative of an economy that's doing really well from a private sector standpoint. Now, part of the reason the private sector has been doing really well is because we've had a lot of fiscal and monetary largesse in recent years. And so that largesse continues to find its way and from a velocity of money standpoint into the private sector. And then you can see the pullback in the public sector here down at the bottom panel, where we're down 1.6% on a 3-month annualized basis. First pullback we've seen in the public sector since 2Q 2022. So that's noteworthy. And if it continues, we're going to start to see a little bit more of a slowdown in growth. But again, if we're going to paradigm C, it's not going to.
Consumers at the top part of the K still have plenty of money to spend. Now, K, the shape K, you got it written right there. At the top, they're the rich people. And you're saying they still got cash. Explain.
Yeah. So households currently have $9.5 trillion on their balance sheets. When you amalgamate checkable deposits and currency plus money market fund exposure, that $9.5 trillion is up from $3.5 trillion prior to the pandemic. So almost a tripling of the amount of cash that's on the household sector balance sheets. And again, when you're running $2.6 trillion budget deficits, that's what we're annualizing right now. Like this is, that money winds up on the private sector balance sheet. And unfortunately, a lot of that money is going to rich people. You think government spending, naturally, it's easy to think about things like Medicaid or food welfare or food stamps or things of that nature. But most of what the government spends on winds up, in the form of it goes to businesses and wealthy business owners, folks like ourselves. So that money is, continues to be concentrated at the top part of the K. And as a function of that, even amid all the sort of, the market decline that we saw throughout the month of March, we actually saw real services consumption growth accelerate on both the 3-month annualized and a year-over-year basis. We accelerated 2.3% 3-month annualized. That number slightly above trend. We accelerated to 2.8% on a year-over-year basis. That number is meaningfully above trend. So as long as, I guess the key takeaway, which is probably on the next chart, as long as the rich people feel confident that the government machine that keeps pumping out $2 to $3 trillion a year in the form of budget deficits is going to keep hitting their top line and ultimately their bottom line, then the economy can remain resilient. And that's what we show here on chart 4, where we show the share of nominal GDP for the manufacturing sector and share of non-farm payrolls for the manufacturing sector. That's down at 10% and 14% respectively. So what that means is 90% of the economy is the services sector from a GDP perspective, and 86% of employment is the services sector from an employment standpoint. So as long as the services sector is doing well, the economy is going to do well, irrespective of what's happening in the goods sector from tariffs or trade.
The macro weather model assesses the probability of regime change over a short to medium term time horizon. What's it telling us right now?
Yeah, great question, man. So one of the things we do for our clients, the number one thing we do for our clients at 42 Macro is nowcast the market regime, and then we filter those signals through our KISS portfolio construction process for retail investors and our discretionary risk management overlay for institutional investors to help them kind of stand on the right side of market risk by, giving them specific allocations for their portfolio and what to be long and short at any given time. We'll use our other tools in our toolkit to essentially help them understand what the full distribution of probable economic and policy outcomes is, so that when our systematic signals via KISS and Dr. Mo tell them to do something different in their portfolio, they feel confident enough because they've been hearing me talk about it for long enough to just, accept the fact that markets are now pricing this side of the distribution in as opposed to the distribution that we're coming from. And so that's why we refresh models like this one on a daily basis, is to again, help paint that distribution of probable outcomes so that they can feel confident enough to make changes in their portfolio when Kiss and Dr. Mo tell them to make changes. And right now, the macro weather model, when you look at the principal components of macro across growth, inflation, employment, corporate profits, fiscal policy, liquidity, credit, interest rates, and then positioning across the various asset classes, the current momentum across all those different features is essentially aligned in a way that suggests, you should have positive outcomes for the stock market, bond market, commodity markets, and Bitcoin over the next 3 months, and a negative outlook for the dollar. And so if that occurred, if this became true, this really rosy scenario for stock market for risk assets, in our opinion, you started work your way backwards from there. Okay, if this came true 3 months from now, what would have to have happened from a policy signaling standpoint to get us there? And in our opinion, when we first saw a lot of green in this model going back a few weeks ago, my initial assumption was that things are going to get so bad in the bond market that the Fed is going to have to come out and do QE and yield curve control and stop and remove financial stability risk from that. Now that we've moved forward in time and we've gotten more signal from the administration in terms of backtracking away from paradigm B, to me, what would have to happen if this just becomes true over the next 3 months is a move towards paradigm C, which, as we talked about earlier, is a lot like what we came from, which was obviously very bullish for markets and very bullish for the economy, but with even more fiscal largesse in the form of tax cuts and some change from the side of reshoring manufacturing. It's basically a lot like what we saw from Biden, but with some supply side economic sweeteners on top of that.
Now, the spending is up, the deficit is up. It feels like maybe it's not up as much as it would have been in the past economy, but it's still up. How do you reckon, hey, we're going to tighten our belt, we're going to kind of go after this stuff, but the spending's still up? Today's episode is brought to you by Core. You can earn yield on your Bitcoin by just holding your Bitcoin. It's simple. Core, the leading Bitcoin scaling solution, will reward you for not selling your Bitcoin. It's not magic. Here's how it works. Core is a protocol secured by elected validators. You can help elect validators and secure the network by simply locking up your Bitcoin on the Bitcoin blockchain. No bridging, no lending, and just holding. When your validator secures Core, it earns rewards fueled by network activity and passes them back to you as yield. With a minimum lockup of just 1 day, when the time lock ends, you get your Bitcoin back untouched. Still your keys, still your coins, now your yield. For even higher rates, stake Core alongside your Bitcoin and multiply your yield. And if you want to see what your Bitcoin is securing, join millions of others in exploring the largest Bitcoin DeFi ecosystem. There are over 100 live apps in the network and the deepest liquidity in all of Bitcoin DeFi. Get off zero and start earning yield on even just 1% of your Bitcoin by going to stake.coredao.org/pomp. Again, that's stake.coredao.org/pomp, or go click the link in the description. Today's episode is brought to you by Gemini. The future is being built today, and the future of currency isn't dollars, euros, pounds, or yen. It's crypto. And Gemini thinks that's a great thing, because a future where money is decentralized, inclusive, and globally accessible, that's a future that we are anxious to be a part of. Gemini teamed up with futurists, technologists, and designers like award-winning artist Matt Griffin, known for his illustrations for Dune, to craft a vision of the future with crypto at its core. The creative theme, Go Where Dollars Won't, emphasizes exploration, growth, and the crypto market's limitless potential. Whether it's going on that Martian safari to capture an unforgettable photo of a herd of woolly mammoths grazing the red planet, or using Bitcoin to pay for your lift pass to go strata skiing down the mountain peak of a breathtaking comet. Whatever adventures we'll be living, one thing is for sure. In a future this fantastic, the limits of traditional currency simply cannot keep up. Financial innovation will usher in this new frontier, and so go where dollars won't with Gemini. Go check them out at gemini.com/go where dollars won't. Again, go check it out at gemini.com/go where dollars won't. Now, the spending is up, the deficit is up. It feels like maybe it's not up as much as it would have been in the past economy, but it's still up. How do you reckon, hey, we're going to tighten our belt, we're going to kind of go after this stuff, but the spending's still up?
Yeah, well, I'll say the punchline for the last slide, but let's just grind through this data because, I think it's really important. I talked to this to our clients, I think either on Saturday or Friday's macro scouting report, but, so many people spend so much time thinking about the future when they're forecasting and not nearly enough time understanding what the base rate is so that you can make, moderated adjustments from the base rate with respect to your forecast, which improve your forecast accuracy. So any young forecasters out there, write down what I just said, because that'll make you a lot better forecaster. But anyway, get into the data. I think it's really important just to understand exactly where we are today. And this is fiscal year to date data through March, 6 months of the fiscal year. It's telling you that we haven't really changed much from the set of a fiscal policy. And of course we have to change from the fiscal policy. They haven't legislated anything. And so if you look at net outlays, we're up 10% on a year-over-year basis. We're up 23% year-over-year basis in terms of the budget deficit. Like if you look at the budget deficit, some of the scariest stuff I see from my perspective, especially in the context of what happened on April 9th and April 11th, is the fact that the elements of the budget deficit, the elements of federal expenditures that really are politically protected and or won't, we can't really do anything about, like net interest. Those elements, which comprise roughly about 70% of the budget across Medicare, Medicaid, Social Security, net interest, and national defense, those five categories account for 70% of total expenditures, right around 5% of total expenditures, and they've been compounding at plus 9% on a trailing 3-year basis. So almost double-digit growth in the things we know are politically protected and won't cut and will continue to grow for a variety of reasons. One, they want to keep taking up defense. They've already, sort of signaled that they want, an additional $150 billion of defense spending. Two, the interest is going to go up another $100 billion just from refinancing from a lower interest rate regime to a higher interest rate regime. And then number three, we know we have, the demographic situation in our country in terms of the rising share of folks over 65. We know Social Security and Medicare are going to continue to rise. This sort of high single digits, low double digits compound growth in these categories, in my opinion, is a feature, not a bug. It's going to continue. And so what you ultimately need to see the deficit stop growing, not go down, the deficit to stop growing, the other 30% of federal expenditures has to compound down 20% to offset that. And obviously we're not even close to on track to legislating down 20% for the other 30% of the budget that's not politically protected. And so that leaves me with the final slide here, which you may take some offense to, and I'm fine to offend, for the sake of discussion. But I think when you start to look at the lack of progress that DOGE is making, and especially in the context of Elon leaving DOGE early to go back to Tesla, and that's a smart choice, right? This is your baby, you got to go fix it. But you're talking about only getting $165 billion of estimated savings through 3 months, with a $7+ trillion budget. The budget peaked at $7.4 trillion annualized in February. I mean, we're talking about raindrops in the ocean right now. And so I think you have to be concerned as an investor and really as a U.S. citizen about DOGE. What was the ultimate intent of DOGE? Is DOGE really here to come cut $1 trillion of federal expenditures? Which, by the way, if they cut $1 trillion from the all-time high in federal expenditures back in February and float that all the way down the budget statement without any negative impact on the economy or revenues, you'd still wind up with a 6% budget deficit to GDP, right? So even if they accomplish their goal, which was $1 trillion, at least as recently as late March, they would still wind up with a 6% budget deficit GDP. And that's before they legislate $5+ trillion of debt finance tax cuts onto the book. And so I got to wonder, was this whole DOGE process just like kabuki theater, just to create a narrative about belt tightening and fiscal retrenchment? But behind the scenes, they're just doing exactly what the Biden administration did, with the exception of, instead of trillions of dollars of spending that blows up our public sector balance sheet, there are trillions of dollars of tax cuts that incrementally blow up our public sector balance sheet, and we wind up in the same place, which is a deficit that continues to grow unfettered and ultimately will become a big problem for us as we get deeper and deeper in this fourth turning.
So I got a couple of thoughts. One, something I didn't know that I recently learned. I took my little behind down to Washington, D.C., and I interviewed the deputy director of the CIA, second in command. Yeah, fascinating conversation. China, cartels, whole thing. I'm in there learning. Bill Pulte, who is the FHFA, I think it is. He's the director there. He's the chairman of Fannie and Freddie. And while I was down there, I ran into a friend who I don't want to say whose name it is, but my friend is a special government employee. Now, when I hear that term, I don't know what that means. I was told, why are people as the special government employee? You can only stay in that status for 120 or 130 days. The reason why so many of these people are trying to be special government employees is they don't have to divest of their assets. So if you become a full-time employee, you got to divest. That's Howard Lutnick, many others. They're selling their assets. They're going into the government. But these special government employees, they don't have to divest. And then they can only stay for, call it 120, 130 days. And then they got to go back. So Elon actually is going back because the special government employee timer is up and he's got to step back. So I didn't know that. I learned that. I thought that was interesting. Doesn't change anything about what they've done or haven't done or whatever, but I think that was an interesting data point because I never heard of special government employee until this administration, right? That's one. Yeah. Two is if you take the 165 billion that they have saved so far in, let's call it 4 months or so, they actually are on track to cut $1 trillion over 4 years. But I think you and I probably look at this and say, hey, you lose steam over time. Like the low hanging fruit goes away. And it becomes harder and harder and harder, right? So you can't just like extrapolate out and say, oh, if you do this in 4 months, like, oh, you get 4 years, whatever. But technically, over the 4-year time period, like they are on track. I just think that you and I think the percentage is going to degrade over time. And so that begs the question, like, what number would we be happy with? If they ended up cutting 500 billion, would we be like, hey, the goal was $1 trillion, but they cut 500 billion, like, kudos, good job, guys. You know, you get a trophy. Or are we all going to be like, hey, you guys said $1 trillion, didn't do $1 trillion, you failed? I don't have a good answer, but I do think it's kind of interesting on like, because they put a milestone out there, it really rallied people and it was aspirational and it attracted really quality talent. But now it kind of turned into the yardstick. And so they're being judged on whether they hit the number that they publicly put out there.
Yeah, that's a great question, man, because I think it's all incremental, right? We're moving, as long as you're cutting, it's better than nothing. But the problem, here's my problem. And you know, I think it's deeper than just what number do they hit. It's, what is our relationship with the rest of the world as it relates to our capital count? And this is why, in our opinion, the bond market broke President Trump on April 9th, because I think they realized that they were trying to facilitate these very heavy-handed current account outcomes via the current account. And they forgot that, hey, every year, the U.S. runs a current account deficit worth 4% of our GDP, which means we consume 4% of our GDP more than we produce. We invest 4% of our GDP more than we save. And part of that, you know, current account deficit is a function of our gross fiscal largesse. You know, we have a non-war, non-recession budget deficit of 7%. That's quite frankly on its way to 8.5% if we legislate the reconciliation process program that the congressional Republicans are currently debating and deliberating. And so, you know, by the end of the administration, let's ignore DOGE and I'll layer on DOGE towards the end. But if we just have what we currently have, which is Biden's fiscal largesse, plus the Republican tax cuts, you're talking about just a standard, you know, static budget deficit, a structural budget deficit of about 8 to 9% of GDP. So going from 7 to about 8 to 9% of GDP. Then you layer on DOGE. Let's say DOGE got to the full $1 trillion. That would just take you back from 8 to 9 to 7, 7.5, right? I don't think they're going to get to the full $1 trillion. And by the way, if they got to a full $1 trillion over the whole course of 4 years, that's 28 plus trillion dollars of federal expenditures accumulated, which means you're only cutting $1 trillion out of that throughout the course of your 4 years. It's a joke. It's a real joke. And so this is why, you know, I don't want to be like cynical. I'm trying not to be cynical about this, but I'm also, you know, well aware that, look, you know, this wouldn't be the first time that the American public has gotten, you know, lied to by people in office. And so, you know, I'll call it out whenever I see it, which is this whole process could very well have been kabuki theater. Right. Like, you know, when you're on stage talking about cutting $2 trillion and then you walk that back to $1 trillion and then you leave and it's only $165 billion. It's just not, it doesn't strike me as a very serious process. Right. It doesn't feel serious, especially in the context of 70% of the budget, which is $5 trillion, growing, compounding at darn near a double digit growth rate because of demographic factors and other factors that the budget they can't control. So it's as if they're not aware of how big the problem is. And they're just highlighting this to create a narrative outside of DC about fiscal restraint and getting inflation down, because this is what was politically popular to talk about. But at the end of the day, I think you have to just watch the numbers and crunch the numbers like we do. And we are on track to a structural 8 to 9% budget deficit by the end of this administration, irrespective of what DOGE accumulates. And I'm hoping as an American citizen that they get to $1 trillion. But right now, it doesn't look like they're going to get there.
Are you bullish or bearish over the next?
Right now?
Yeah, through the summer.
To be honest with you, I don't know. I don't think I need to have an answer to that right now. Like, you know, we're completely systematic investors. So if our systems take up risk, I have a really credible framework for thinking of why that is likely to occur in terms of paradigm C, because paradigm C is bullish for markets. But I'm also smart enough to know that the administration could easily look at the markets doing well and have it give them a false sense of confidence in order to try to start facilitating outcomes towards paradigm B again, right? And so this is a lot more, this isn't like forecasting an economic outcome or forecasting Fed policy and having it be some static outcome where, you can have a lot of confidence in that as an investor. If you have a tremendous amount of confidence right now as an investor, it's because you don't know what you don't know, quite frankly. Not you, but any investor that has a tremendous amount of confidence based on this process doesn't know what they don't know because they don't realize the dimensionality associated with, hey, they could easily try to negotiate in a very aggressive manner if markets are up over the coming, if markets are doing well over the next, let's call it 2 months in this 90-day window, they might try to negotiate heavy-handed again. And negotiating heavy-handed again is going to cause markets to have a lot more pain because then the markets are going to go from expecting paradigm C to expecting paradigm B again. And more importantly, you're introducing a whole host of risk in the bond market. I think it's very important to talk about what the Japanese finance minister said last week. This is Scott Bessent's counterpart in Japan. He was asked on Bloomberg, you guys are America's single largest foreign holder of treasuries. He said, they asked him, will you use this as a chip in the negotiations? And he said, well, yeah, it's a chip we can use. Whether or not we use it is up to the Trump administration. Right. And so to me, I'm like, this is what I've been trying to say for years now, which is our twin deficit situation is a problem. And it's an extremely big problem and very timely problem if the Trump administration wants to bully the world into an outcome that they don't want. Right. And so that's my fear is that as investors, that as soon as you position for paradigm C or get very convicted on paradigm C, reflexively, the positive reaction in the market could cause these guys to, double down on paradigm B again. So I don't know the answer. I'd be remiss to pretend like I have the answer, but I tell you exactly what I'm doing in my portfolio, which is the same thing I've been doing the whole time, which is to dispassionately execute our systematic KISS signals. KISS will get incrementally bullish over the course of the year if we're talking about paradigm C becomes true. However, it will maintain a relatively, a defensive position if paradigm C becomes less true. And one final thing I'll say on KISS is that there's been a real divergence between our signals for the crypto market and our signals for the stock market. And I think you and I might have talked about this last time I was on, but Bitcoin has developed defensive properties in this most recent market cycle in a way that I have not seen it yet. The beta to the S&P is like 1 now as opposed to 2 to 3. And it also, you could see it trade a lot better than stocks did. And so in my opinion, I think the reason, I feel really confident that, having a portfolio exposed to stocks, gold and Bitcoin is going to do really well in a variety of scenarios. And obviously that portfolio will get incrementally bullish if the scenario winds up, if paradigm C becomes the highest probability outcome in the minds of other market participants.
Where can we send people to find out more about 42 Macro?
I know that was a lot, but I appreciate you, man. Look,
listen, they got to go get the signals.
Yeah. Well, no, you and I could sit here and talk for 10 hours about, all the different, shapes of the economic and policy distribution. But at the end of the day, what I'm doing in my portfolio is KISS, because ultimately KISS knows more than me, and more importantly, KISS will get to the right answer. We understand that the market is smarter than us, and it's better to use quantitative market signaling to guide your portfolio than stuff about DOGE or paradigm C or B or A. That stuff just helps us understand how those signals may evolve in the future so that when they do evolve, we feel confident enough to just make the changes in our portfolio. So 42macro.com if you want to check out those signals and get access to them.
I learned something every single time we talk. My friend, today is no different. Thank you very much. We'll do it again in the future.
Always a pleasure, brother. Thank you so much, man. Have a good one.